In this final video on stock valuation, we want to talk a little bit more about the component parts, the variables that we use, how we find them, and then of course we will explore continuing into the techniques that you can use to find value for in this case common stocks. And keep in mind as we discuss these variables and the techniques, what can a manager do to have influence on those variables so that the stock price will grow in value? So let's think first, we're talking about something referred to as the constant growth model, where we have to have some idea or forecast on what we think will happen to dividends in the future. So we need to calculate the predicted growth rate of dividends. So one of the ways that we can do this, and there's more than one way, but one of the ways we can do this is through time value of money. Here we have a stream of dividends from 2010 to 2015. Dividends started at $1. They ended up at $1.40. We need to calculate the growth rate from 2010 to 2015. So in the worksheet that's designated Stock Valuation Dividend Model, we can enter in the dividend section, TV for time value, the beginning and ending dividends, and then N. Now N, if we're looking at time periods, right, since we know time, it's just the most recent 2015 minus 2010 gives us 5 growth periods. And in this case, for this company, growth rates was roughly 6.96%. So we can use that in our model for determining the value of a stock. Now, this is historical dividends. We want future dividends. So if there's something we know about the company, good or bad, we can adjust this number somewhat to reflect our prediction of the future, right? This is just a picture of the past. What is the prediction of the future? And that's the number we want. So it seems like it's very cut and dry here, but in reality, the actual number that's used is a far more complicated number to come up with and to evaluate. To find the required returns, we've talked about this in some other videos, we can use the security market line from the capital asset pricing model. In this case, we assume that the Treasury bond, 30-year Treasury bond, is at 4.75%. The company has a beta of 1.45, and the stock market average has been around 12%. Having said that, again, plugging that into the components of the stock valuation dividend model worksheet, we get an average rate of return here of 15.26%. And again, there are other techniques that we could use. And in the end, if we had more than one technique, we could average them together maybe and just take a consensus of the different techniques and what they say. So again, having said that, we know we're thinking about the future, not the past. So we might want to make some corrections here. So for this particular stock, again, here's our growth rate, 6.96%. Required return is 15.26. We know that the most recent dividend was $1.40. So when you plug that into our worksheet, this stock has a value of $18.04. If we include a price, the current price is $17.50. We then come up with the decision question. Do you want to buy this stock? Would you pay $17.50 to get $18 in return? And likewise, if you did pay $17.50, you would expect to earn about 15.5%, and the required return on this stock was 15.26%. So this investment is a good investment. So we would want to purchase this stock. Now, to look at some variety or some variability in these models, we have to look at one of the assumptions of the constant growth model. And that is that sometimes dividends don't grow at a constant growth rate, or we don't even assume that they're even close to a constant growth rate. We know for a fact that there are some companies, especially companies that are used to innovation and new products, new inventions. We know that these companies have specific kinds of growth rates related to those inventions. So this company has invented a brand new toothpaste that doesn't require a toothbrush. So this innovation is going to increase their earnings for a short period of time until corporate saboteurs steal the process. So for the next 3 years, earnings are going to grow at 15%. It'll eventually return to the industry average of 8%. The most current dividend's $2. Required return on the stock's 12%. And the stock's been selling for $61.75. Now, if you notice, I'm talking about earnings here. And we'll talk about this a little bit in some later videos on dividends and earnings in particular. But if the company doesn't change the proportion at which they pay out dividends, if their dividend payout ratio is consistent, then the growth rate in earnings will also be related to the growth rate in dividends. So that's why we can use this earnings growth rate here for the company. So we have a model, it's called the supernormal stock valuation model. Again, plugging the numbers into our worksheet. What this worksheet does is it calculates the dividend in each year of the supernormal growth period for 3 years and finds their present value. It then estimates what the price will be at the end of the supernormal growth period. In this case, the present value of that is $58.46, and then it adds those two things together. So this is the constant growth rate model. It assumes these first 3, though, grow at a different growth rate, while everything past the 3rd year, they all grow at this industry average to infinity. So this stock has a value of $64.78. The stock price, we say, is $61.75. So this, again, would be a good investment for us to make. So what are the issues with dividend valuation models? Well, really, there's just a couple of them. Number one is, what happens if the company does not pay dividends? A dividend model will only work if you have dividends. The other question we have is, what would happen if the company's growth rate in dividends is greater than the required return? In our formula, the denominator would turn negative, and then that would mean that you'd have a negative price. A negative price can't exist. So if that situation is true, the dividend valuation model, we would be able to use it. And additionally, what do you do for companies that aren't corporations or companies that don't trade publicly? A sole proprietorship, partnerships, maybe family corporations. How do we find the values of those companies since they do not have dividends themselves? So we're going to take the next section and talk about those particular kinds of companies. And this model is referred to as the free cash flow valuation model. And if you notice, it looks very similar to the dividend growth model. We have next year's free cash flow divided by the difference between a required return and the growth rate of free cash flow. The R sub A here is the firm's weighted average cost of capital. This is just a number that represents the average cost of financing the company's long-term growth. So again, we get the same basic idea, except now in this case, instead of getting an answer that is in per share terms, this is the value of the entire company. And of course, we don't want to know the value of the entire company. We just want to know the value of the ownership of the company. So we can extend this then to a formula. The value of the stock is the value of the company, subtracting from it the other forms of financing. If the company has long-term debt, you subtract the value of that. If they have preferred stock, you subtract the value of that. So in this case, again, what we end up with is $1 for the entire ownership of the company. So what would happen, do you think, if you wanted to buy a 60% ownership in a partnership? You find the value of all the ownership and multiply it by 0.6. That would be what you would consider the value of buying the ownership, the 60% interest in that company. So here's an example where we know the company's free cash flows for the last several years. We know their weighted average cost of capital, growth rate of free cash flows. We also need to know how much debt they have, how much outstanding shares they have. And in addition, we also know what the cash value is, or how much cash they have in their checking account. So when you plug these numbers in, we end up with a value of the company. Again, here's the free cash flow. We need to find the growth rate of free cash flow. In this case, 10.67%. Now, we've thought that that's actually a little bit on the high side. So we wanted to be a little bit more conservative, and the growth rate is actually 3%. So again, we have made the change ourselves to change the growth rate because we feel that this number is unreasonable to be sustained into the far distant future. So again, we end up with a value of $10.3 million. So $10.3 million. We then subtract out the value of the stock, of the debt, excuse me. And in this case, we also want to subtract out the amount of cash that's available. Because quite frankly, if 10.3 million is the value of the company, since we're buying the entire ownership, this cash is ours. So we are essentially including that in the money that we could use to buy back the entire operations of the company. So the actual market value of common is $7.55 million. And if we knew that this was, say, a publicly traded or a privately owned corporation, and they had 300,000 shares, we would be estimating that the value of this company is roughly $25.17. Again, this is a model to use when dividends are not available. So continuing with our analysis, let's look at some other ways to value stock. One of the techniques we could use is something called the book value per share. This is the accounting value, right? So it's the value of the assets on the books minus the value of the liabilities on the books. Now the liabilities will be very close to market value. They're typically recorded and sometimes marked to market as the value of debt changes. But total assets are a historical number. So this particular value, if you will, if you take owner equity here, divided by the number of shares available, that is book value per share. Essentially, it's a historical number and does not reflect anything at all about current value of the company. And I guess in a nutshell, it ignores the firm's expected earnings potential. It really just looks at a historical value rather than a investment kind of value. Now, the liquidation value converts all of the assets and liabilities to market value. It's a much more realistic number than book value, obviously because it's looking at current market values of the assets. However, it still really doesn't consider earning power of those assets. And actually, on a much more simpler basis, I guess, or rationale, not all assets have prices, and not all assets are even on the books. So we may be ignoring some major assets of the company that aren't included in this liquidation value number. So book value per share, liquidation value per share are things that we could use. However, they both have some substantial flaws in the techniques themselves. One of the things we can use is something called the PE ratio. Now, the PE ratio just reflects the amount of money investors are willing to pay for each dollar of earnings. So the PE ratio is the price divided by earnings per share. So again, this is price, earnings per share. This is kind of a picture of optimism, as you all. How optimistic are investors about the future of this company? If they're very optimistic, they're willing to pay higher prices for the earnings of the company because they expect the future to be much better. Now, if we do some algebra with this and solve for price, the value P sub 0 is the estimated earnings per share for the next period multiplied by the estimated PE ratio for the next period. So these numbers, quite frankly, are pretty easy to find. You can find these in Yahoo Finance. So they'll give you a pretty good picture of what you think the value will be, not today, but what the value will be at the end of the period. So this will tell us if what the change in value should be over the next time period. So as an example, this company is expected to earn $2.60 over the next year. And we're assuming an industry average PE ratio of 7. So the firm's per share value should be in the ballpark about $18.20. Now we are using what's referred to as the stock valuation multiplier model. Now there are several of these multiplier models that are used in real life. And we don't need to use the industry average PE ratio. We could use the forecasted PE ratio for the company. Again, most of this information is fairly readily available on Yahoo Finance. So as we move on, let's consider then, what are the variables that are going to affect stock prices? First of all, we need to understand something about dividends, and this is expected dividends. So if you increase, or if you suspect that we will increase future cash flows, values should increase. If dividends go up, value should go up. So any action that the manager can take that would increase dividends without changing risk should be undertaken because it will positively affect the owner's wealth. What about risk? If you increase the risk shareholders must bear, you also increase the risk premium. Therefore, you're increasing the required return. So if the required return increases, that is going to have an impact, right? If risk goes up and required return goes up, value is going to go down. So if the required return can be affected by changes in the risk-free rate, even if the risk premium remains constant, the value will change relative to that number. So if risk goes up, required return goes up, that means that the value of the asset will decline. This is what we've been talking about in the class or in the previous videos about what's referred to as the risk-return trade-off. Now finally, there is obviously a combined effect, right? A financial decision rarely affects just one variable. So most decisions are going to have multiple impacts throughout the company. As firms take on more risk, shareholders expect to see higher dividends. So the net effective value depends on the relative size of these changes. So if we can understand a little bit about how they work together, we ultimately can have an understanding of how our decisions will affect the value of the firm. So that's the end of our videos on stock valuation.